Anand,
You're
we
on
don't
mute.
hear you, mate. I don't know if your mic is on or off. Yeah, welcome everyone, new joiners. How's everyone doing?
Hi guys. So this is the options session, and previously we have taken one session. This is the second session uh, on the options front. So am I audible to you guys? Right?
Yeah, we
Yes,
can
yes.
hear you. Yeah.
I'm not able to hear you. Okay, let me. So I'm Anand Raj. Uh, as you already mentioned, Delta Exchange is the home of the crypto options, and this is how you can check the daily volumes of options on the Delta platform. Friendly disclaimer: this presentation is for educational purpose. Delta Exchange do not provide any trading ideas, setups. So please consult your financial advisor before taking any trades or position. Presenter, distributor, or nature of this material PPT is not responsible for any profit or losses. So just a quick recap of what we uh, you know uh, took away from the last section. The ATR is the average true range which measures the volatility. From this chart, we can see that BTC and Ethereum's are the the assets where we can have the maximum volatility. And as a trader, we love the high volatility. Options we mentioned, we have two types of option: the call option, put option. We buy call option when we feel the underlying is going to go up. Put option we buy when the underlying is about to go down. This is for the call options. For put options, yeah, call option when you bullish, put option when you're bearish on the market. Options premium, there are two components: intrinsic value and the time value. Intrinsic value is just the spot price minus the strike price, and whatever component is left in the premium is the time value. So moneyness of options contract, in the money, at the money, and out of the money. In the money is when you strike prices, uh, market prices above the strike price, you are in the money. When your strike price and the spot price are same, it is at the money. And out of the money scenario is when your chosen strike is away, or the or rather I'll say the market price is lower than your strike price. That case is OTM. So to simplify this, I have taken this chart. So this will make you very easy to understand. For call option, let's say your underlying is at 7,000, so this is at the money for you. So any strike which is which you have chosen above 7,000 are going to be the out of money, and any strike which you have chosen below the current market price will be the in the money scenarios. Coming for the put side, it is going to be reverse. At the money is 7,000 because the current market price is $7,000. For example, I have chosen. Okay. Out of the money is any strike which are below this, and in the money is a scenario, all the strikes which are above your current market price. So as mentioned last time, and we are going to have this in detail this time, the options premiums are uh, calculated and are governed by these Greeks. The Greeks are delta, gamma, theta, vega, and rho. Delta, just to remember, make it easy for everyone. We can just make a simple way. Delta starts with D, so you can think it as a direction. So delta is a Greek which will reward the trader for his choosing right direction. So delta is change in options premium versus the underlying asset. Okay. So delta have a range from 0 to +1. So for for at the money, why we choose the at the money calls? Because the for at the money calls, the delta is 0.5, and for in the money, that means when your chosen strike is below your market price, you become in the money, and in the money your delta is +1. That means now you will be rewarded in equal component to the underlying. That means if your underlying is moving $100, your options premium will also increase by $100. So this is basically, you can multiply this. For at the money call option, your delta is 0.5. That means if your underlying is moving by $100, your options premium will increase by 0.5. That means $50 will be incremental value in your options premium. Also, the takeaway or this Greek, to handle this Greek or to play with this Greek, what we can take away is that lower delta value we can keep at entry. So for that, we can choose the ATM calls or put, whichever direction we are playing. The reason is, if we choose ATM, we are at 0.5 delta. When I say 0.5 delta, it means that if your options, if your direction is right, you will be 50% divided for your direction. And if your direction is wrong, the damage that will happen to your options premium will not be 100%. It will be 0.5. That means it will be 50%. Okay. Calls have positive delta and puts have negative delta. Then there is second degree, which is called gamma. Gamma role is to accelerate and decelerate delta. As I mentioned, the at the money calls are having delta of 0.5, and in the money deltas calls are having delta of +1. So how this 0.5 becomes slowly and gradually to 1? It happens because of gamma. Because as your direction is right, the every time gamma starts accelerating your delta, and hence your 0.5 becomes 1 after a certain period of time when your direction is right. Okay, we will see this in detail with an example as well. This is theta, and I will show you this how to check this on delta platform. The next Greek is theta, which is time decay. It starts with T. You can just try to remember this with T, which is time decay. So options have some time value. So as the time keeps on passing, the options premium start decaying, or that time component in that options premium start vanishing. So theta is actually measures the options premium change over the passage of time. So how we can play with this Greek, or what we need to take away? So when buying options, we should try to choose plus 30 days contract, so that we have sufficient time to play. And for shorting option, we should be looking for a short term contract, so that you get a time benefit. Why to take the time benefit over here? I will take this with an example with a graph. Just I'm trying to give the definition of the Greeks right now. The other Greek is Vega, which is Vega starts with V, so you can remember is that volatility. So Vega is the change in options premium versus change in your IV, which is implied volatility. Okay. The next Greek is Rho, starts with R. You can remember this by rate of interest. So Rho is basically measuring change in premium versus rate of interest rate. Okay. So let's discuss each and every Greek in detail with an example in a more practical way. So this, what I mentioned, that delta is from 0 to +1. At the money is having a delta of 0.5. Options at ATM money delta approaches 0.5. So this is, so let's say your options, the underlying was at 50. Okay. So when it starts going above, so this delta graph is for call options. So when your underlying starts moving from $50 to $60 to $70 to 80, 90, and eventually $100, so here you are at the money right now. Okay, but your chosen strike price is 50, let's say, because that is at the money, and the underlying has moved to $100, and your chosen strike is $50. So when the underlying has moved to $100, your chosen strike has become in the money, and that is what you can see, the delta has become 1. So this line will gradually keep on increasing, and it will become 1. So here your underlying and your options premium will increase at a similar rate. Any move in options premium, sorry, the underlying will reflect in your options premium. Okay, that is why we generally say when you buy options, you should choose at the money so that you have 0.5. Okay, and when your direction is wrong, it starts reducing, the delta starts reducing from 0.5 to 0. So here your options premium will start decreasing because your direction is wrong, and since the direction is wrong, your delta will start decreasing from 0.5, it will actually become 0. So this is the role of delta. Where do we see this delta value of the options premium on delta platform? This I will show you when I'll take all the Greeks in detail. The next Greek is theta. Theta is basically measuring the options premium decay over the time. This graph tells you the options premium decay rate as the days passes by. You can see as we are approaching more towards the expiry, or I can say as we are approaching more towards the contract expiry, the slope of this graph is increased. Here it was slightly flat, and here you can check, see the slope. The slope has increased, and as the days are coming closer, the slope is increasing. For the same reasons I mentioned, when you sell the options, you try to keep the options expiry as close as you can, so that the slope, this decay in options premium because of theta effect, becomes your friend and not as an enemy. Okay, time value reduces to 0 as the options approaches expiry date. Time here is expiry. On expiry, the options premium, whichever on expiry or the settlement, the options premium will only have intrinsic value and no time value, because the time has elapsed. The contract is over now. This is the graph of IV, which is implied volatility, and Vega since measures the implied volatility. So basically, it is the measurement of the public or the traders' expectations in the market, which decide the future price of the underlying. So during the major events, because of the heavy participation of the people, of the traders, the the options premium start increasing because of participation of the people, because of more and more number of traders willing to pay premium for any strike price. As last time I mentioned that conqueror wants to buy a property. So let's say in that case, if that property was very hot area, many people of his society, of his community would have come and said, okay, I also want to buy this property. Do you think the buyer, the seller of that property would have agreed to just take $1,000 from conqueror as a one time deposit just to wait for 3 months? No, definitely no. So if he has more number of people approaching for the same property, definitely the guy will increase his price. So that's what happens over here. When there is a lot of participation of the people, of the traders, the options premium start increasing because the volatility has increased in the market. The participation, the perception of people have changed. Okay. So coming to this point, the IV implied volatility, this you can just try to correlate and understand with this pendulum. So this is basically a pendulum which the mean position is this, and these are the extreme positions of this pendulum. So from this graph, I'm trying to convey that the extreme positions of the pendulum, they are the unstable positions, and the pendulum balls are in a hurry to move towards its mean position, which is this. And as you can see, the 95%, the 68% time of this entire pendulum ball is passed in this zone. The rest 14% time it passes in this zone. The next 2% time it passes in this zone, and the rest 0.5% time it passes in this area, which is very unstable and very sensitive. So when the implied volatility is high in the market, it is a place, it is a area which is unstable for the price, for the market, and generally premiums have to start reducing to its mean, or when I say to mean, I mean to say to its fair value. When there is a high volatility in the market, the options premiums are inflated. They are not at their fair value. Because of that, you must have seen people, traders saying the premium is very high. The for anything which I need to pay $100, currently I have to pay $300 for it. The reason is simple: the IVs are increased. So in that case, the options premium have become inflated. So as mentioned, that this area is very unstable, and the price doesn't do not pass a heavy time or a good time over here, and eventually it comes to mean. So when you see high premiums, it is always good to sell them. So the takeaway from this Vega or wallet, or this Vega, which is a Greek, is to sell the premiums when they are high, when the premiums are inflated, okay, and buy the premiums when they are low, when the IV is low, okay, so that the premium when they increase, you get the benefit of it. And the move from this unstable zone toward the mean is very fast. So if when you see during the events, as soon as the event is over, the the IV cool off is very drastic. It doesn't take a lot of time, it happens quickly. So whenever you see high inflations in the market, in the premiums, and the IVs are high, look for the selling of the premiums or the selling of the strike price. Moving towards the next slide, which is dynamic leverage, which I mentioned that the options in itself comes with a concept which is dynamic leverage, where I mean to say, you hold less number of shares when you are wrong, and you hold more number of shares when you are right. So let's understand this concept in detail. So for an example, I'm taking 100 shares, okay. So 100 shares I have taken. So these are two tables. This is the table where any trader is trading in shares, and this is another trader who is trading in options. So we are comparing the profit and loss of trader 1 and trader 2. So the trader 1 has chosen any stock who is currently trading at 200, okay. So this guy trader A has taken 100 shares of that company, and the options trader has taken one lot, and this lot size of this was 100. So since 200 was the market price of that particular share, so this guy has chosen 200 call options, because 200 is at the money. And for at the money, I mentioned the delta value is 0.5, okay. So just go step by step, and I'll make this presentation and this entire concept of options very easy. 100, trader 1 has taken 100 share, trader 2 has taken one lot which is having 100 shares, and has taken 200 call option which is at the money. For reference, the delta is 0.5 and the gamma value is 0.05. Scenario number 1, the stock starts moving from 200 to 201. So this guy is making a profit of $1, and he has 100 shares, so he is making a profit of $100 over here, okay. Coming to the options trader, this guy, his options premium is, the initial option premium was $15, so he paid a net value of $1,500, okay. So 15, so the next, since his direction is right, so this trader, options trader, should be rewarded for his right direction, right? So his new premium, or the new options premium, will be 15 plus the delta value, which is 0.5. So 15 plus 0.5 is 15.5. So his net value will be 1550. So the net profit after this $1 move in underlying, this guy is making a profit of $50, whereas the stock trader made a profit of $100. Okay. Scenario number two, the stock moves from 201 to 202. This guy again is making a profit of $1 and 100 shares he has, so he again made a profit of $100 over here. Coming to the options trader, as I mentioned, the gamma will accelerate delta. Okay, so now, and why, what amount the delta will increase? The delta will increase by the amount gamma is. Okay, so the new value of the delta value is 0.5 plus 0.05, which is 0.55. Okay, so now the options value will be last, which is 15.5 plus the delta value 0.55. So the option value is G $16.05. The net value is 1605. The profit is $55. Coming to the next scene, when the underlying move from 202 to 203, there's a profit of again $1, 100 shares, $100 profit. The options trader, again the direction is right. He should be rewarded for his right direction. The gamma will increase the delta. So the new value of the delta is 0.55 plus 0.05, which is 0.6. So his options value will be 16.65. Net value 1665. The profit is $60. From 203 to 204, $1 profit, 100 shares, $100 profit. Again, delta, the delta is increased from the gamma. The new value of the delta is 0.65. So the option value is 16.65 plus 0.65, which is 17.3. Net value 1730. The profit is $65. So guys, what we understood from this, every $1 incremental increase in the underlying, the cash guy or the trader, one who was trading shares, made a constant profit of $100. Okay, coming to this side, the options trader, he was making, for $1 move he made a profit of $50. Next time he made a profit of $55. Next time he made a profit of $60. Next time he made a profit of $65. On next $1 move he would have made a profit of $70. So just understand, he's holding the same quantity, the same share, the same strike price, but his profits are increasing, as if it is looking that he has started increasing his quantity. He's holding more number of shares. Okay, let's come to the reverse part of this. The share has started dropping from 204 to 203. There's a loss of $1. 100 shares he had, loss of $100. Here the delta value will decrease because the direction is reverse now. The gamma will decrease the delta. The new value of the delta is 0.65. Options value is 17.3 minus 0.7, 16.6. Net value is $1660. There is a loss of $70. From 203, the underlying came to 202, loss of $1, 100 shares, $100 loss. The new delta value is 0.65 minus 0.05, which is 0.6. Options value is 15.95, the net value is 15.95. There is a loss of $65. So you hold more number of shares when you are right. You so your profit starting. So here you are making constant loss, $100 losses, but here your loss started reducing, $70, 65. Next week will be $60, then $55, then $50. Okay, so your profits start increasing as your direction is right. Your profits start decreasing when your direction is wrong. You have done nothing. These guys are your friend. They are playing with you, the gamma and the delta. Okay, any questions on this? I know this was certainly a slightly tough part of this entire options trading, and I wanted you guys to be familiar with options, how gamma delta plays a big role, and how these are calculated. So this is something manually I have calculated and placed on this sheet for you guys. I hope you guys would have got a sense. I just want you to ask me any queries on this. Let's make it more interactive, because I know this is slightly going to be because the next slide beyond this is going to be practically totally a practical exposure. So if you are very clear on this part, it is gonna be fun now. Any question, guys? Cool. So I'll come to the Delta platform and firstly show you the Greek. Coming on the options tab, where you can see the entire option chain of Bitcoin.
Anand,
Yeah.
Anand, hold on. There's a question by DXV. Can you answer?
Yes.
There are two
So
actually. He has one above also.
yes, DXV, you are right. That's what we tried to got through this PPT. Your profits, that the way it behave, the options, that's what I call it as dynamic leverage. DXV so good, so option trading is saying okay, okay. So to open the position, same position size, it costs you less by options trading. Why? Right, because in options we pay a premium. That's what I said. Conqueror is buying a property of $10,000, but he has just given a token or a premium of $1,000. So in options, you are not paying the entire money. You are just paying some $15. Here, if you calculate here, the amount will be 200 into 100. So it is gonna be 23 $20,000, and here you are just paying $15. So just see the difference. So that is why the chances of making huge profits or exponential profits or sizable profit and options is higher compared to traditional market, because you pay less premium. And you can understand that after two more, like let's say 204, 205, 206, 207, your profits in options trading versus your profits in traditional market would have been a linear line, almost the same, because you would have been in the money, and in the money you would have made the same profit as the underlying was making. Okay, any more queries, right? And the premium, okay, and the premium is the maximum risk. Yes, that is the maximum risk. When the options you are buying, that is the maximum risk you are going to have. For example, like I mentioned, Concor is buying a property or a land. He has paid $1,000. He had a contract of 3 months with the seller of the property, but due to certain reasons, Concor changed his plan, or he thought that news which was flowing in the market that airport construction might happen, and if doesn't happen, so in that case, Concor will lose $1,000 only. So hope DXV I have explained to you now. Clear? Anyone can just put up your queries. If you want, you can just unmute yourself, you can speak up as well. Yeah, DXV, I'll come to that option selling part as well. Let's go sequence by sequence, please. No man, not at all.
No man, you're the only one willing to learn here. Asking question is not about noobness; it's about willing to learn.
Correct.
The more you ask, the more you interact, the better you learn.
So I'll just take you through the Theta platform, and I'll show you these Greeks which we just had words. Okay. So I'll pick up an expiry of 3rd of Feb. The BTC price is 22,900, roughly I'll say 23,000. So at 23,000, you can see here the delta is 0.5. Okay. And let's say 23,000, and let's say I'm picking up 21,000. You can see this guy who would have taken 21,000 strike would have been in the money. So his delta is 0.88. So he is very close to a place where his profits and the underlying profits are equal. Okay, see these guys. These guys are almost running in equal ratios to the underlying. So delta is clear. Gamma will just increase the delta. So we have no control, or we have no place to play with gamma. This is the vega volatility. The implied volatility in the market. You can see the vega right now. The vega is 6.43, 8.43. This is the theta. You can see that these are the negative values over here. Okay, so this is the amount of premium that will erode, or that is extra in this premium, or this is the time value over here. Okay, so you can choose accordingly. Coming to coming to prices again. So you can see the implied volatility which we spoke, 20,000. The IV, the below the price, you can see the IV, it is written over here. From here you can see the bid price slash IV. So these are the IVs, implied volatility. Okay, 52.5 and 54.6. This is the implied volatility from the buyer side and the seller side. So in crypto market, in BTC, you can 55% till 55% IV. It is a very fair value right now. If any time during the events, you can see the IV is going above 100 as well. In my previous section, I think I showed you one setup which I took, or which I was having an eye on, where the IV, due to the CPI print, went from above 80%, and the IVs crashed, and I was able to uh, the premium washed out 70% in just a few hours or so. So this is how the IVs are written over here, and this is how you can play from the IVs. So the major Greeks which I have totally mentioned, the delta, gamma, vega, theta, and rho. Rho you cannot do anything. Rho is something which is governed by the interest rates, which are governed by the banks. You need not, because they don't change much at all. So they don't have much impact on the options premium. Gamma's role is to change the delta. So the only Greek which um, uh, is to watch is the implied volatility. Delta, as I mentioned, you just have to be very close to 0.5 when you are buying options. Okay, for selling options, you need to look for the high IVs and less expiry, less number of days for expiry. How to check how many expiry, how much days you have for the expiry? Here it is written, time to expiry 7 days. When I choose 28th of Jan, you can see the expiry time is 1 day, 22 hours and 11 minutes. For 27th Jan, you can see that expiry is in 2 hours and 11 minutes. This is the call side information. This is the put side informations. You just can simply roll it down and you can see it over here. For helping people, also there is a color difference. You can see these are of different colors and these are of different color. The only difference is because of the in the money and out of the money cases. Okay, so like the BTC is at 22,900 right now. So any strike below 22,900 are in gray, and the strikes above 22,900 are in black color. So these are all the out of the money strikes, and these are all the at the money and in the money strikes. Are we good on this? Coming toward the put side, 23,000. So any strikes below 23,000 is in the money. Any strike which is above 23,000 is out of the money. Sorry, I just took it away. Sorry. Any strike which is above 23,000 is in the money, and any strike which is below 20,000 is out of the money, because the market has still not came to 22,800. Because if we are taking put, we are bearish on the market. That means we are looking market to fall, but market is at 22900. Okay, so that is case. This is out of the money and this is in the money in the put side. Any questions till now, guys? And these values which we have shared, these are the in the dollar terms. Okay, so now the question comes, how these options premiums are calculated uh, uh, on the basis of these Greeks, delta, gamma, vega, rho, and theta. So we generally must have heard of Black-Scholes model, which is BS models of the option. So this is a model for the calculation of the call price or the call premium. A very complicated stuff though, but it is just have been put for knowing purpose. No one in this planet would manually calculate it, because by the moment you calculate it manually, the optional premium would have changed again, because it is having a time component in this. Okay, so it is just for knowing. If anyone would have asked, okay, how the options pricing are calculated, it's a Black-Scholes models. That's it. So it's a disclaimer for you guys again. Whatever I have covered is just for the information purpose. Uh, so please do consult your financial advisor before taking any positions in the market. Thank you. Any question, guys?
Yeah, guys, feel free to ask anything, like anything. Don't be shy. We are here to learn. And by the way, don't get overwhelmed with this info, with all these. It's going to get a lot easier once you get into it. And on the next session, we're going to go, I think, please, Anand, correct me if I'm wrong. In the next session, we're going to be doing more practical examples, practical usages, and the next series will be practical side of it.
So let's say also let's do one thing. Let's try to take one trade setup, or let me share one trading idea in front of you guys. Okay, so let's say BTC is 22,900. You are expecting the market to go up. That means you are expecting market to go something above 22,900. So what you can do? You could have taken 28th of January expiry, and you know, so 22,900. Okay, this you can look to buy over here. So you can just simply buy this call option of 22,900, or if you want to keep the round figure, you can keep this as round figure. Also, you can see there is a high OI over here. The Delta exchange platforms also helps you with the open interest buildup. So you can see more than 1 million options contracts are standing over here. So there is definitely, it's all interpretation. How would one like to interpret this OI information? Looks like the market is heading for 23,000. Okay, so one can just go and just buy this option contract, and as the underlying moves from 22,960 towards the 23,000, this options premium will increase, and one can definitely make the profit out of it based on if the underlying moves in the right directions. Okay, so this is
Anand,
yeah.
I think there's a question from Coco. So, Coco, if you want, you can ask a
Uh,
question.
Not a question, Conqueror. Actually, I joined late, almost 20, 25 minutes late. I missed the previous part. I will definitely go through the recording. But after that, if you have a question, how, I mean, can we put it in the Discord in education section, or how do we get those answers?
Coco,
It's bad on my part. Yeah, I understand completely.
in my Discord, there is a Delta squad, and Delta
Mm-hmm.
specific for this group. And you can ask
Okay.
your questions over there, and we will answer.
Okay. Fine. Thanks.
No problems.
So any question next when we will be taking the next session, as I have taken the quick recap today, the same way in the next session I will take a quick recap, and you are more than welcome to ask your query that time over Ani. Okay.
Yeah, either you can use the time on the next session. You can ask live, or you can ask the questions beforehand, and we can cover it on the next session.
Fair
So
enough. Thank you.
both can do,
Thank you,
yeah.
Anand.
And
Thank you.
DXV is asking question, raising hands.
Some of the point you were sharing before, Anand, but when Delta is close to open, I will close to open, etc. Is there a general guideline? So DXV, this is no guideline. It is just the takeaway of the people, how people wish to take this how to take this information. Okay, like as you can see, the Delta Action platforms comes with the options analytics board as well, where there is a couple of informations of the implied volatility. Okay, the IVs. Okay, as you can see, whenever we see a high IV, there is a crack in the IVs. So you can make use of this informations of the high IVs and accordingly make your trades and plan your trades. Okay, coming toward this position, open interest, which is options. The open interest means how many contracts are open. So this can give you a clue that where people are generally betting on, or where the people are generally playing. So what I'll do, let me show you D2 expiry. So you can see at 19,000 there is a high OI, 2.71 million. Okay, let me show you more expiries of W1. Again here you can see 3 millions of contracts are standing over here. So do we think the BTC is going to 19,000? So this is how this information, this is very crucial information. In the options trading, the very first PPT or slide which I showed you, that options comes with a handy information which gives you a clue where the market is heading or can lead to. So this is somewhere telling me that 19,000 looks not a very feasible price to come in near future, at least till 1 week. Okay, and this is why the maximum people are playing in this area. Or I would not say maximum people, I would say the maximum contracts are open over here. And I guess we as a trader are very smart to believe when we say maximum contracts, because these are of the big players, the institutions. Okay, so that's what you can see on the volume versus strike. So this is this particular page, open interest, this is the most interesting. And if you start playing around this area, I believe your maximum, you will get an insight in just few days. And just by this information and correlating your study on the charts can give you a clear picture what you need to do, whether you need to buy the call or whether you need to sell the puts, or whether you need to go for the futures. So in the next session, we will be taking buying of the options and selling of the options. So in the next session, we'll cover when to buy and when to sell the options. And we'll take the next, uh, more practical. And I think that theoretical part is completely over. And I, as mentioned, that Delta, Vega, you just need to know them. What is their role in options trading and how they can impact your trading or your profits and losses. But you cannot do anything about them. So stop. So we need not to worry about them. We just need to know them. That's it. The only thing takeaways are, when you are buying options, try to be at the money. Reason is very simple, delta is 0.5. So you want your delta from 0.5 to 1, so that you get a 50% profit of the underlying profit. And if your direction is wrong, you should not be punished 100% for your wrong direction. How much beautiful statement this is. You should not be punished 100% for your wrong direction. This is itself taken by, controlled by delta. Options are giving you such a, so yeah, this. And then the IV will give you a clear picture that when the options premiums are high, and you need to accordingly take your positions when the implied volatilities are low, when the options premiums are fair valued, and when they are high, you need to look for selling of the options. In the, this is something which I'm saying for the in ideal case scenarios. So in practical, yeah, there can be a slight tweaks in your playing, but this is the ideal case scenario that you should be looking for selling of the options. When the implied volatility is high, you should be selling options of less expiries, shorter expiries.
Anand, can you show the strategy builder in Delta?
Sure.
So
here,
guys, there is this incredible tool in Delta Exchange called Strategy Builder, which you can paper trade. Basically, you can try whatever you learned here in these sessions. You can give it a try. You can paper trade some options that you think that will be a good trade for you, and see how they develop. And then on the next
So
session, we can also discuss those.
sure. So here under resources, you just need to go. The very first step is strategy builder. You would be coming to this page of a strategy builder, and okay. So what you can do over here, either you can look the profit and loss manually. So I'll do both the things for you guys. Okay. So the BTC is trading at 20 to 945. Okay. So let's say anyone of, let's say, of 8 days expiry, uh conquer anyone wants to buy the 23,000 call option. I am putting a virtual trade over here, so I want to buy 23,000 call option.
By the way, yeah,
I-
please be careful because you can place also the real trades over here.
Correct.
So yeah,
Real trades from here, right?
so but make
Okay,
sure that you're doing the paper trade. Okay.
right, right. So what you can do, cool. So you can just come to this. Here you can see add strategy. When you click this area, we on this platform we have already placed all the possible strategies of options trading over here. So you want to take a long call, we have already put up a graph over here. Let's say you want to take a long call spread. What is the meaning of this? What is the consequence if you take this trade of this strategy? How to check these? How to do the strike selections? We have already put up a graph, the explanation, and the strike selections. You can just go. You can put favorites as well for your favorite strategies, whichever you are playing. So you can play with long put, short call spreads. So accordingly, you can start playing around these areas. I request you, I wish you guys can go through this, can go through all these strategies. And next time, if you have any doubts on this, feel free to reach me out. We can discuss this in detail over a length.
By the way, guys,
So,
don't get confused by this. Just know that there is this is there because we're gonna be doing in the next sessions. We're gonna go through most of these strategies in the next sessions. But you see, don't get overwhelmed with the variety. Okay. So, but this is basically it's good to see what you could do. What are the possibilities with the options? Okay, it's not just 2-3 dimensional; it's 5 dimensional trading. So that's the beauty of options. There is something for everyone, like every kind of trader. If you think that market is not going to move, there's a strategy for you. If you think that market is going to move so fast, so in a short amount of time, there's a strategy for you. So that's the beauty of options. And this is a great place to see everything all at one place. And plus, put your paper trades and see the outcome without getting hurt, basically, with your loss of real money. So maybe we'll go through this. So don't worry about this for now. But it's good to know that they're there. Okay, just you can give, as Anand said, just give it a look. Don't get overwhelmed, and try to take one trade, one paper trade, and see how it goes. Okay. So at least you know what we're talking about in the what we're going to talk about in the next sessions.
all right, any queries, any doubts? As Concora mentioned, so options you can play in infinite ways. There is no limit. You can mix and match them in any ways. You can buy 19,500, sell 2,500. To hedge this, you can buy 21,000. You feel that there is a high premium 20,000, you sell this 20,000, but there is a risk the market can go above 20,000. You sell 22,500. So you can do anything whatever you want to. There is no
Exactly.
limit.
It's a whole
And
different world.
anyone in options trading can make such a position that market can do anything, but you will not make a single penny loss. I know this is a very bold statement, but if you start playing with options, I can say, and Conqueror have witnessed this, The
Yeah.
sun can stop rising tomorrow, but if you make the positions right, if you has your position in a clear way, your position cannot become in loss if has properly. Any doubts, guys? I think we can wrap the sessions, and we'll be having more practicals in the next session. And okay, my homework is study. I'll show you again, guys, the strategy builder, so that you can. This is resource. Just tap on this, go to the strategy builder. You'll land to that page, this page, where you can just simply come to this add strategy, and you will have all the strategies over here. This was the options analytics dashboard. This open interest. I wish and hope you guys play with this area. This is something, as an options trader, you should be playing and should be knowing, and you should know how to play around these areas. And this gives you the best informations of the market, where the market is looking to head on. Okay. All right, guys, that's all from my side. I hope I was able to give you more informations of the options in the simplest way possible. If any doubts are left, feel free to come back to us in the next session. We will definitely do a recap, and see you then.
All right, guys. Thanks to Anand and our partners at Delta Exchange to make this possible. You're gonna love options, man. I mean, I guarantee you that. Once you get the hang of it, you're gonna love it. And if there's no more questions, let's wrap it up here and see you guys in the next session. And it will be soon, probably next week. We'll let you know. Thanks for joining.
Thank you, guys. Thank you, Coco. Everyone. Bye bye.
Cheers, guys. Take care. Have a great weekend. Bye bye.
Yeah, have a good